On August the 6th, 911.5 million shares of SpaceX became legally sellable for the first time, about $100 billion worth. The financial press called it the moment of truth. The stock went up 6%, and by Friday the story was over. The story was not over. August 6th was the smallest release on the calendar. I know how that sounds. Let me earn it. There are 3.59 billion more shares still locked from that same pool, releasing in tranches between now and December. And behind those sits a single block of 6.4 billion shares that does not unlock until June of 2027. That one block is 7 times larger than the thing everyone spent a week worrying about. It is 4 times larger than every tradable share of SpaceX that exists today. For most of last week, the entire financial press pointed at one date. Analysts modeled it. Day traders streamed it live. Headlines counted down to it. And when the stock closed higher that afternoon, the consensus flipped in a single session from bracing for impact to declaring the danger past. Both of those readings share the same flaw. They treat August 6th as the event. August 6th was not the event. August 6th was the first small piece of an event that runs for another 10 months. This video is about what actually unlocked, what did not, and why the number that got quoted in almost every headline was measuring something different from what people thought it was measuring. None of this requires you to have an opinion about the company. It requires you to understand one mechanism, and that mechanism will apply to every large listing you see for the rest of your investing life. Start with what a lockup actually is, because almost every confusing thing that follows comes from this one definition being blurred. When a company lists on a public exchange, it does not release all of its shares into the market. The founders hold shares. Employees hold shares from years of compensation. Early investors hold shares from funding rounds that happened long before anyone outside the company could buy in. Those holders sign a contract that prevents them from selling for a set period after the listing. That contract is the lockup. The date it ends is the lockup expiration. Here is the part that gets lost. A lockup expiration does not sell anything. It does not move a single share. It changes one thing only, and that thing is permission. Before the expiry, an early employee holding shares is legally prevented from selling. After the expiry, that same employee is legally permitted to sell. Whether they actually do is a completely separate question, and it depends on their tax situation, their view of the company, their mortgage, their diversification, and 100 other things that no headline can model. So when you read that 911 million shares were unlocked, the correct mental translation is not 911 million shares were sold. It is not even 911 million shares are for sale. It is 911 million shares changed from cannot to may. That distinction sounds pedantic until you notice that essentially the entire week of coverage collapsed it. The panic framing assumed permission would convert into behavior at close to a 1-to-1 rate. The relief framing 24 hours later assumed that because it did not convert immediately, it never will. Neither of those is a finding. They are both guesses about human behavior dressed up as analysis of supply. Think about who actually holds these shares because it tells you something the headline number cannot. A software engineer who joined 8 years ago and took stock instead of a higher salary is not a trader. That position may represent most of what they own. Some of them will sell a slice to buy a house or clear a mortgage. Many will hold because they believe in what they helped build, or because selling all at once creates a tax bill they would rather spread out. Early institutional investors behave differently again. A fund that bought in at a fraction of the listing price is sitting on an enormous gain, and its obligation is to its own investors, which usually means taking some of that gain off the table on a schedule rather than in a rush. Rushing moves the price against you, and these are not people who enjoy moving the price against themselves. So the honest answer to how much of that 911 million will actually be sold is that nobody knows, including the people holding it, some of whom have not decided yet. What we can say with certainty is that the number is not zero, and it is not all of it. And every confident forecast you heard last week was picking a point on that range and presenting it as knowledge. There is actual research on this, and it is worth knowing. Studies of lockup expirations across many companies find an average abnormal return of roughly negative 1.5% around the date, along with a large spike in trading volume. Not a collapse. A small, measurable drag, plus a lot of shares changing hands. And there is a reason the effect is that small. Lockup dates are not secret. They are printed in the listing documents months in advance. Every institution with a position knows precisely when they arrive. A known future event does not ambush a market. It gets priced in gradually as the date approaches, which means by the time the date arrives, much of the adjustment has already happened somewhere in the preceding weeks. Hold on to that idea, because it explains the 2 days that everybody misread. If you followed this story across more than one outlet, you saw 2 different dollar figures attached to the same event. Some coverage said $123 billion of stock was unlocking, other coverage said $100 billion, a few said 101. Those numbers are far enough apart that at least one of them looks like an error, and if you were trying to work out how worried to be, that gap matters. There was no error. All of those figures describe exactly the same 911.5 million shares. The only thing that changed was the price used to value them. 911.5 million shares valued at the $135 listing price comes to $123.1 billion. The same shares valued at the August 5th closing price of $108.27 comes to $98.7 billion. Valued at the intraday low the following morning, $95.8 billion. Same shares, same event. A $27 billion spread produced entirely by which day someone did the multiplication. This is not a trivia point. It is the first sign that the coverage was reporting a headline rather than a mechanism. A number that swings by $27 billion depending on the timestamp is not describing a quantity of stock. It is describing a quantity of stock multiplied by a price that was falling fast while everyone was writing about it. For the rest of this video, the figure is about $100 billion, because that is roughly what the shares were worth at the moment the permission actually changed. But the more useful number is the share count, not the dollar value, because the share count is the thing that is fixed. 911.5 million shares. Remember that figure. Everything that follows measures against it. Here is the sequence, in order, because the order is the whole story. On Tuesday, August 4th, after the market closed, SpaceX reported its first quarterly results as a public company. On Wednesday, August 5th, the stock fell almost 14%. It closed at $108.27. That was an all-time low, and it was the second worst trading day in the company's short public life. Then, on Thursday, August 6th, the shares unlocked. The stock dipped to $105.11 early in the session and closed up 6.1%. That 6% gain is the number that produced every relief headline you saw. The supply arrived, and the stock rose. Therefore, the reasoning went, the supply did not matter. Look at what that reasoning is actually comparing. It is measuring a 6% gain from a floor that had been established the previous afternoon by a 14% decline. The stock did not rise from a position of strength. It bounced off an all-time low, one day after its second worst session ever. Measured from the June peak of $225.64, the August 5th close was down 52%. Measured against the $135 listing price, it was down almost 20%. Measured against the first day closing price, down almost 33%. A 6% recovery inside those numbers is not evidence that supply is irrelevant. It is what a stock does after it falls 14%. Now hold that against what we established a moment ago. Lockup dates are known months ahead. The market had been looking at August 6th since the listing documents were published. If the arrival of extra supply was going to depress the price, a meaningful part of that adjustment would already have happened in the sessions before the date, not on the date itself. Which raises an uncomfortable possibility that almost nobody stated plainly. Some portion of that 14% Wednesday may not have been about the earnings at all. It may have been the market doing on Wednesday what everyone was waiting to see on Thursday. I want to be careful here, because this is exactly the kind of claim that gets asserted with false confidence. There is no way to cleanly separate an earnings reaction from an anticipatory supply adjustment when both land in the same 48 hours. Anyone telling you they can decompose that move precisely is guessing. But the direction of the logic is sound, and it is supported by the research. Known dates get priced in early, which means judging a lockup's impact by what happens on the day of the lockup is like judging a storm by looking outside after it has passed. Every piece of coverage last week used some version of the same phrase. The float more than doubled. That is true. It is also one of the most misleading true sentences printed this year. The float is the portion of a company's shares that can actually be bought and sold by the public. Not the shares that exist. The shares that trade. Before August 6th, SpaceX had roughly 638.9 million shares in its float. After the unlock, that rose to about 1.5 billion. That is a multiple of 2.43, more than doubled. The headline is accurate. Now, put those numbers against the size of the company. Before the unlock, the float represented 4.9% of all shares outstanding. After the unlock, the largest release in the company's history, after 911 million shares changed status, after roughly $100 billion of stock became legally sellable, the float represented 11.8%. Doubling a very small number gives you a slightly less small number. 88.2% of this company still cannot trade. Sit with that because it reframes everything you have watched happen to the share price. The rise from the listing price toward $200 in the opening days. The 52% decline from the peak. The 14% Wednesday. The 6% Thursday. Every one of those moves happened inside a sliver of the company. At the peak, roughly 1/20th of SpaceX was setting the price for the other 19/20ths. That is why the volatility has been extreme, and it is not a mystery or a scandal. It is arithmetic. When a small number of shares are available and demand is large, small changes in demand produce large changes in price. Scarcity amplifies moves in both directions. It made the early rise steeper than the business justified, and it has made the decline steeper too. The total share count here is roughly 13 billion. I have derived that two separate ways. Once from the pre-unlock float percentage and once from the post-unlock figure, and the two calculations agree to within 0.8%. So 13 billion is solid. 13 billion shares in existence. 1.5 billion of them tradable. Which brings us to the question the coverage never asked. Where are the other 11.5 billion, and when do they arrive? The August 6th unlock was not a single gate opening. It was the first tranche of a staggered schedule, and the schedule is public. Those 911.5 million shares represented about 20% of one restricted pool. That pool totals roughly 4.5 billion shares. 20% of it went out on August 6th, which means 3.59 billion shares from that same pool are still locked. They do not all arrive at once. They release in tranches tied to a mix of fixed day milestones after the listing and earnings windows, running from late August through to a final expiry in December. Roughly 7% of the restricted pool at a time, not a cliff, a drip. There was also a conditional early release built into the agreement. If the stock had traded at least 30% above the listing price on 5 out of any 10 trading days before the first earnings report, an additional 10% of eligible shares would have been freed early. That threshold sits above $175. The stock spent that window going in the opposite direction, so the trigger never fired. Notice what that means. The early release provision was designed to let more supply out when the stock was strong. The stock was weak, so the supply stayed locked, and it is still queued behind everything else. And then there is the block that makes all of this look small. 6.4 billion shares are held under a separate arrangement that runs for a full year from the listing date. Those shares unlock on June 12, 2027. There is no early release provision attached to them. 6.4 billion shares. That is 7 times the entire August 6th tranche. It is 4.1 times the total float of SpaceX as it exists today. After the unlock, that everybody spent a week calling the moment of truth. Put it plainly, if every share that unlocked on August 6th had been dumped into the market on the same afternoon, it would still have been a seventh of what is scheduled to become sellable in June of 2027. That is why the framing of last week was wrong in both directions. The people predicting a crash were pointing at a date too small to produce one. The people declaring the danger past were declaring victory over the first fixture of a season that runs into next summer. I want to be precise about the claim in this video, because the temptation here is to slide from a fact about supply into a prediction about price. And those are not the same thing. What is established? The amount of SpaceX stock that can legally be sold is scheduled to increase substantially over the next 10 months, and the largest single increase has not happened yet. That is not analysis. It is a reading of a published schedule. What is not established? What the share price will do about it. Supply is one input. Demand is the other, and demand over 10 months depends on revenue, on capital spending, on index inclusion, on interest rates, on how the business actually performs, and on the collective mood of everyone who might want to own a piece of a rocket company. None of that is knowable from a lockup calendar. And remember the base rate. Across many companies, lockup expirations produce an average abnormal return of about -1.5%. Not a collapse. A drag, and a modest one, precisely because these dates are public and the market has time to adjust. So if you came here expecting me to tell you the stock is going to fall, I am not going to, because I do not know, and neither does anyone who says it with confidence. What I will tell you is that the analysis you were given last week was measuring the wrong thing. It treated a scheduled, publicly documented, staggered release as a single event with a single verdict. It valued the same block of shares at 3 different numbers on 3 different days and